As the largest and most significant EV manufacturer in the world, Tesla frequently reflects the state of the EV market as a whole. Every ups and downs garner considerable attention and are subject to in-depth analysis, all to determine the current direction of the EV industry. At the moment, everything seems to be about plummeting. Tesla's recent demise is an unmistakable portent of the EV market's demise, and these 6 fairly conspicuous indicators. Number 6. The second growth surge is not anticipated to materialize. Presumably, any reader of a newspaper is aware that Reuters recently reported that Tesla is discontinuing production of the Model 2. Although Musk expressed disapproval of Reuters on his X platform, he never explicitly refuted this information. Known as the Model 2, this was anticipated to be the Austin-based automaker's next major undertaking, but it appears that this will not occur. Experts predict that this electric vehicle will not be completed within the next 18 months as Tesla has shifted its attention to the robo-taxi project. Recent rumors indicate that this could make its debut in August. It would also be the first autonomous vehicle produced by the company to function as a taxi. What does this imply for the EV industry as a whole? It is, in fact, quite indicative. In certain global regions, the electric vehicle market is experiencing a regressive trajectory following a period of rapid expansion that commenced a few years ago. This signifies that the early adopter phase has concluded and the middle class is not yet prepared to adopt EV technology due to the exorbitant cost of electric vehicles. It was anticipated that models such as the Model 2 would alter this, approximating $30,000 to $25,000 in price at launch. This electric vehicle was intended to be a cost-effective option with a respectable range and technology, appealing to the general public at last. However, it appears that this will not occur at this time, suggesting that additional electric vehicle manufacturers might follow suit. In any case, it became abundantly evident from the most recent EPA proposal that rapid electrification is not feasible. Consequently, many other companies are deferring their EV projects, just as Tesla has done. Number 5. Both sales and profit are declining. Tesla has experienced consistent and accelerated growth over the years as evidenced by its impressive sales figures, profit margins, and stock price. That is no longer the case, however. Up until that point, sales figures were increasing, but the enforced price war resulted in negligible profit margins. The initial price of a Tesla model has decreased by $2,000 in the past week, bringing the Model Y down to approximately $4,634. An assault on the Gigafactory in Germany, among numerous other factors, contributed to the previous quarter's growth decline to 17.4%. Nonetheless, the most significant issue is sales, which are 88.5% lower. Normally, such an occurrence would not justify concern. However, it is noteworthy that this is the first decline in sales in 4 years. It is evident that none of these figures are cause for concern. However, they do provide some insight, particularly when analyzed in the context of the EV industry as a whole. Specifically, Tesla has been the only automaker to generate a profit from electric vehicles. The entire time, however, both established automakers and EV entrepreneurs have been incurring losses as a result of their inability to reduce expenses and optimize production. We can therefore only speculate as to how dire the situation has become in light of the present slowdown, steep discounts, and other factors that hurt profits. While the majority of businesses are delaying their investments in electric vehicles, some, including Fisker, are on the verge of insolvency. Presently, Rivian is confronted with record low stock values. Number 4. Significant reductions in employment. This dire financial situation at virtually every EV manufacturer directly leads us to the following indicator: enormous layoffs. Recently, Tesla made a public announcement regarding the reduction of its personnel by 10%. Considering that the Austin-based company employs over 140,000 individuals globally, this signifies the elimination of over 14,000 positions, a plain indication that Tesla must reduce expenditures. It is especially indicative that this does not simply involve terminating the employment of individuals. Additionally, there has been a significant departure of prominent individuals, including Daniel Ho, Drew Baglino, Rohan Patel, and Tanushi. Is it premature to declare their decision to evacuate the sinking ship? We are uncertain. Regardless, we're aware that 6,700 of these 14,000 cutbacks pertain to North American facilities located in Buffalo, California, Texas, and Nevada. Additionally, it is worth noting that 400 positions will be eliminated in Germany, whereas the majority of redundancies will occur in China, where Tesla has recently experienced a substantial 43% decline in revenue and sold a mere 300,000 vehicles in the previous quarter. This describes the present state of the EV industry precisely. Automobile manufacturers are in a frenzy to reduce costs, and redundancies are widespread. Following the 10% workforce reductions that were implemented in February, Rivian has recently disclosed the initiation of a subsequent phase of redundancies. Ford and GM are also reducing staff in their electric vehicle manufacturing facilities, whereas Fisker recently informed its employees via letter that the company's days are essentially over. Number 3. A Cybertruck was recalled. Everyone had been anxiously anticipating the arrival of the Cybertruck, which is now a reality after years of extensive development setbacks and numerous delays. However, the commencement of events has been less than ideal as grievances regarding substandard construction quality surfaced only a few weeks following the product's appearance. One of the most intriguing was the poor design of the accelerator pedal and its cover, which allowed the vehicle to become immobile during complete acceleration. NHTSA was compelled to issue a recall. As a result, the announcement stated that the malfunction was caused by an unauthorized lubricant modification utilized during the assembly of the accelerator pedal pad component. Lubricant decreased the amount of retention on the cushion. This recall merely serves to underscore the broader context, which unequivocally demonstrates that electric vehicles are quite problematic. In numerous instances, manufacturers encounter significant challenges in resolving the issue. In conclusion, the finding of a recent Consumer Reports survey that EVs are 80% more problematic than gas-powered vehicles is not unexpected. Tesla is, if not the most dependable electric vehicle manufacturer in the industry. Even more significant challenges confront other electric vehicle manufacturers, particularly established automobile manufacturers, who are already subject to numerous recalls. In addition, GM was compelled to discontinue the sale of electric vehicles, such as the Chevrolet Blazer EV, on account of an interminable series of software malfunctions. Electric vehicle manufacturers are unable to resolve reliability concerns, which can only result in EV sales declining further in the future. Number 2. The decline of China. China has been regarded as the most prospective market for electric vehicles thus far. Exceptional growth was observed amidst a market saturated with affordable and sophisticated electric vehicles. Despite this, it appears that development had to decelerate even in this region. Despite facing intense domestic competition, Tesla has been managing reasonably well in this market. However, the situation began to change when the company experienced a significant 43% decline in sales by the end of the last quarter, resulting in the sale of only 300,000 vehicles for the period. Concurrently, the American EV manufacturer is compelled to engage in the price war initiated by BYD to maintain its market relevance. Discounts in the thousands of dollars apply to all three models, Model 3, Model S, and Model Y, making it abundantly apparent that the company is currently losing money on its electric vehicles in China. Tesla's share of the Chinese electric vehicle EV market has been reduced to no more than 10% as a consequence of the substantial decline in sales. Although that remains sufficient for a tie for second place, given that BYD controls 1/3 of the market, it is indisputable that the disparity is widening. Number 1. Individuals desire hybrid vehicles. The decline in Tesla sales and the stagnation of the EV market as a whole indicate that consumers are not enthusiastic about adopting EVs. They opt for hybrids as an alternative, incremental step toward electrification. The most recent sales figures prove this point. More specifically, hybrids experienced a significant surge with a substantial 70% growth rate in North America during the final quarter. They currently hold a 9% share of the US market, which is a significant difference in comparison to EVs, which have a 7.2% market share. And Toyota, the foremost manufacturer of hybrid vehicles in the world, is savoring every moment. Sales have reached all-time highs, and the profit for the previous year surpassed $30 billion. In the interim, Tesla generated approximately $15 billion in revenue before the significant deceleration. Does this indicate that the electric vehicle market is about to collapse? Difficult to tell. Nevertheless, it is abundantly evident that the middle class will not soon adopt electric vehicles. However, they opt for hybrids due to self-evident rationales. Hybrids offer enhanced convenience, increased dependability, and reduced cost. Hybrids alleviate concerns related to charging and range anxiety. Considering these factors collectively, it becomes evident why a majority of consumers prefer gas-electric hybrids over pure electric vehicles. Thanks for watching. Don't forget to like, subscribe, and hit the bell icon to stay updated with our latest content. See you in the next video.